Hello, and welcome to In Plain Sight, a Trading Hub podcast. It's great to be back with you guys. I very much enjoyed the AI podcast, but I'm sure all the listeners will be relieved to see that we're back to full strength here. We're also back to talking about regulatory enforcement actions. So I think anyone who's been monitoring the space involved in compliance surveillance has recently seen the order that was brought up by the Securities and Exchange Board of India, or SEBI, against Jane Street. So there's a 105-page interim ex parte order that they issued alleging what they've called index manipulation against Jane Street, who is, of course, a very large quantitative market maker and proprietary trading fund. So in today's podcast, we'll be getting into that order, going through the findings that SEBI laid forward as part of that, and also kind of going through some of the strategies and some of the activity executed by Jane Street. So just as a quick summary and timeline here. So the order alleges 18 different derivative expiry days across January 2023 through March of 2025, where SEBI found that Jane Street had executed this cross-product intraday index manipulation. And that included tradings across the equity and futures markets, as well as the options market, and where they were essentially distorting index pricing. They also identified 3 instances of what they called extended marking the close. So this was a similar cross-product trading pattern, but obviously was much more focused in the end of day trading in those same markets. So as part of the order, SEBI had also directed the firm to deposit approximately the equivalent of roughly 553 million USD into a escrow account with a lien in SEBI's name. And so this, to be clear, it wasn't a fine or, in kind of some of the enforcement actions we often see out of the US. This wasn't an admission of guilt by paying this amount, which Jane Street did. They still very much have the ability to challenge this order, and I think to some extent have already indicated that they will. But what this has done is then allowed them to start accessing the Indian markets again, because as part of this order, they had to, of course, pay this amount, which SEBI described as being, proceeds of kind of the unlawful gains that they received from the scheme, and also they were banned from accessing the Indian markets. So they have paid that, and I think SEBI has also come out and publicly said, that certain restrictions, trading bans, account freezes would cease to apply, provided there's kind of ongoing compliance from Jane Street. So that's
it's interesting that Jane Street happy or seem very willing to pay that large amount of money to get into the Indian market.
Certainly says something.
I think one of the most striking things in the SEBI notice actually is a very detailed breakdown of how much money Jane Street have been making in this market. So I think over the year or two in question, it's the equivalent of more than $3 billion from a combination of stock futures and index options and stock indexes, right?
I think another telling fact that goes hand in hand with that might explain some of the motivations here is that the statistic is that 93% of Indian retail investors lose money on Indian option markets.
Yeah.
Now, I think there's zero-sum game, right?
Yeah. I don't think that's an unusual statistic either. So I'm fairly sure if you look at, if a spread betting firm, someone who is essentially providing brokerage services to retail, that 90+ in any jurisdiction, 90+% of their customers will lose money.
True, but I think there is a specific specificity about the Indian market in that the depth of the option market. I'm sure we're going to go into this. It's massive. It massively outweighs the cash market.
Yeah.
So I think in any case, it's definitely an interesting characteristic that surely hasn't escaped Jane Street's attention as to why they are so desperate to be in this marketplace.
And quite interesting how you mentioned the amount of profit that they made in the Indian market specifically, as I think that was actually the driver for the investigation and ultimately this order coming about. So there was, and it's mentioned in the SEBI order, how there was a employment dispute between some former Jane Street lawyer employees and their new employer, where I think they had alleged that it had stolen some of their trading strategies. And as part of that, disclosure process, it was real just how much money Jane Street was making in the Indian options market. And SEBI obviously took note of that, and actually was one of the drivers for them actually investigating this activity, which is quite interesting.
And at this point, Andrew, maybe it's helpful to just spell out the actual fact pattern. What's the precise allegation about Jane Street's conduct?
Yes, as I mentioned, there was two specific strategies that SEBI lays out. The first one being this kind of cross-product intraday market manipulation, and then also there was the extended marking the close manipulation. So for the intraday marking or intraday manipulation of the index, in the order, they very much focus in on one specific day. I think, Shane, that was the 17th of January example, right? Maybe you could kind of give just kind of a quick run through of the.
Yeah. So I think it's important. So I think we should lay out in broad strokes what the allegation is, and then I think there are some nuances we want to dive into. So exactly as you say, two separate they've divided the day into kind of 3/3, let's say. You've got what they call patch 1, patch 2 in the afternoon, and then the extended marking the close period. So patch 1, the allegation is that in the Bank Nifty market, which is a subset of the Indian main stock market index, which is Nifty, there are 12 banks called the Bank Nifty, and that's something that is traded as a collective. The allegation is that Jane Street loaded up on the index features for the Bank Nifty and the underlying constituent stocks, whilst simultaneously entering into kind of synthetic short positions that were built using a combination of calls and puts on the Bank Nifty constituents and the index. And this is something that I think on paper, and certainly Jane Street states, is kind of normal arbitrage strategies where you kind of capture the pricing difference between these two markets. So the allegation is that happens, in SEBI's words, aggressively during patch 1. In patch 2,
they noted it was quite aggressive too, in terms of certainly the trading between the constituent stocks and the futures. I think they mentioned it on that January 17th day in particular. They made up about 20% of the market in there,
and accounted for all the price move, right?
They have. Well, so I think they have. Should we?
Let's cover the day. So I think so patch 1 is this interplay between the constituents and kind of the cash market and the synthetic short option positions. Now, for a classic index arbitrage strategy, there's a way that looks, and we'll get into later on as to the arguments as to why it does look that way and why it doesn't look that way. Patch 2 in the afternoon, the allegation is that Jane Street aggressively sold its cash market position in order to benefit its short option position. This is a SEBI allegation. And then during the extended marking the close, which is the final hour of the trading session, the close period of the calculation fixed methodology for the Indian market is in the final 30 minutes. And the allegation, the reason why this is called extended marking the close, according to SEBI, is that in the final hour, the allegation is that Jane Street sold aggressively to push the price down into the expiry of these derivative contracts. So the broad strokes, that's what the allegation is. Now, in the 105-page document, there are some specific points that come out that are quite interesting. So, for example, in a classic arbitrage strategy where you're looking to capture the pricing difference between the cash market and the derivatives market, for example, I think the whole point is that you're trying to capture a risk-free profit, and therefore you should be balanced in terms of exposure. I think SEBI's allegation is that there was an imbalance. I think the number was 7.5 times in delta adjusted, maybe 7.3.
Yeah.
7.3 times more short exposure in the options market than in the cash market during patch one. I think that's quite an interesting stat. I don't know if there are any views in the room on that in particular.
So why don't we lay out why don't we just lay out the case for the prosecution for now? So essentially what they're saying is that these markets are intimately linked. And as we've already kind of skated over earlier, it just so happens that there's much more trading activity in the options market. And that trading activity is conducted by kind of more retail style investors. And they actually give some numbers among those 105 pages where they just highlight that it's kind of orders of magnitude more market participants in the options market than there is in the underlying cash or single stock futures, for instance. So I suppose the prosecution's case is saying, look, these options markets, they're priced with reference to a much less liquid cash market. Jane Street's acted in an extremely aggressive way in patch one. They've been bidding up the single stocks. So they've not only been buying, they've been buying at progressively more aggressive prices. So, typically they're bidding through the last traded price or at the last traded price rather than, being passive, providing liquidity further back. So they've had, SEBI would claim they've had a material impact on the clearing level of the constituents of the index. And that's fed through to in a completely automatic way, pretty much, into the kind of fair pricing of the options and allowed them to buy put options cheaply and sell call options more expensively. And because that market's much more liquid and the investors are less sophisticated, they've managed to do that in a way which hasn't had the same kind of price impact on the underlying index, which is worth going into maybe. And then they've done the inverse in the other day. And so for this to be market manipulation, there has to have been a deliberate creation of an artificial price. So I suppose the activity in the stocks and the single stock futures, that's the manipulative pattern. And then the allegation is that they then captured that with preferential option pricing. And it's also just to round it out, it's worth noting that this is option expiry date, right?
Yeah.
So normally, if you manage to get into a trade at the wrong price, you still got to pay to get out of it, right? So, it's all very well that you've managed to get a good price on these options, but when you come to close out of them, you might worry that you're going to move the market against you. But here they benefit from the fact that at 3:30 p.m. when the market closes, you get out with zero transactions.
Yeah.
Effectively at mid, because these things just cash settle.
Yeah. So I think it's interesting. So if that's the case for the prosecution, I think the case for the defense probably the point you made about aggression when you were laying that out at the start. If there truly is an arbitrage to be had, you kind of have to be you got to move quick, right? It makes sense that aggression is not. It's normal. Like you want to capture it before it goes away. No.
100%.
Yeah.
So there's an old joke, isn't there, that an economist who believes in the efficiency of markets and a trader are walking down the street, and they both spot $100 on the pavement, and the economist says that $100 cannot exist because if it did, someone would have picked it up already, and the trader says, "Yoink, that person's money."
Yeah.
And then it is gone. So the economists, they're all both kind of right.
Yeah.
But you're exactly right. Free money is very attractive, and people act to take it very quickly. And so you can't hang around if there's an arbitrage opportunity necessarily. You would expect maybe to be lifting offers in the cheap market and hitting bids aggressively in the expensive market in order to just get as much done as you can as quickly as you can before other people pile in an efficient market.
And I think it's quite, again, just to speak or make the argument for the defense a little bit. I think there are probably some characteristics here that are worth observing. So we spoke earlier on about the imbalance between the size of the options market in India and the underlying cash market. Another thing that is mentioned in the SEBI order, but also elsewhere, in the halls of power, I've overheard them in much smaller, less powerful halls. But I think one of the things, I mean, Jane Street was a massive liquidity provider in this market, just generally. And I think after the ban, before the $540 million or whatever was deposited in escrow, volumes on the Indian market dropped massively. So there is an argument that this was dry. You know, you're providing liquidity, you're making markets more efficient. You're, kind of, I hesitate to say providing a bit of a public service. It's hard to say that when you're picking up $4 billion along the way or whatever. But that is true. I mean, the liquidity providers in this market in a significant way.
Yeah. So I think all of this is made more complicated too by, no doubt, the complicated nature of Jane Street. There's more than one entity involved. You know, I've never worked at Jane Street, but I would hazard that there was more than one trading strategy being deployed on the Indian markets at any given time. And what's been presented is the aggregated transaction and order flow. Now, so, much of which may well have been legitimate, or all of it could have been legitimate. And we're looking at the aggregated output of several different unrelated trading strategies. It's definitely possible. But even within the securities and derivatives listed, there are many different flavors of arbitrage that could be conducted. So, I think some of Jane Street's public riposte to this has been around the fact that they've been engaging in high volume arbitrage strategies. And, if we look at what's been involved, we're talking about stocks, single stock futures, index futures, and options. So, of course, single stocks and single stock futures can, at expiry, they kind of are the same. So they have to trade very similarly in line, and there's some small discounting. But, I suppose people can conduct very simple arbitrages between those two things. People can conduct arbitrages between the index level, so where the index future is trading, and where the underlying single stocks or the underlying single stock futures are trading, because, again, at future expiry, that index will price as the weighted sum of the underlying cash stocks. And then there's a series of arbitrages that can be conducted in the options market, the most famous being kind of put-call parity. So if you, for instance, buy a call and sell a put at the same strike, the payoff that you've created is exactly the same as the payoff that you're going to get from the future. So if you take the aggregate kind of option premium that you've paid and add that to the strike, if that's different from the future level, there's some free money available there, right? So, and you can be conducting that kind of strategy at every single strike, and there are many liquid strikes on any given index option. So it's possible that even a very straightforward arbitrage kind of identification execution strategy would be resulting in when you look at the aggregate outputs, it's possible that you could see dragons that actually aren't there, because you're looking at the sum of the trading activity, but in fact, in that example, the trading activity is being determined by very simple agents looking at narrow things separately, right?
Yeah.
Now, I'm not saying that that's what's happening here at all. And in fact, there's many good questions that can be asked from the trade data that SEBI provide. But it's just pointing out that it's Jane Street has thousands of people working at it. So, and I'm sure they have many people thinking about the Indian markets if they're making this much money there.
Yeah, absolutely. I think there are a few things that kind of stuck out to me too, in terms of reviewing this, and especially reviewing it from the lens of somebody who is in a compliance team, in surveillance. If you are kind of monitoring this type of activity, I think, Mike, the points you made there too are these are very interconnected markets and multiple different products being traded. So you really need to be understanding their positioning in the whole and understanding really where they're positioned. And I think also how they're positioned too. So I think, Shane, you kind of alluded to it a little bit when you were kind of going through, their kind of the intraday manipulation between patch 1, patch 2, but specifically the size of their options position compared to the position in the constituent stocks and the futures. I think you mentioned there that it was 7x in terms of that size. I mean, to me, that kind of sticks out a bit in terms of, well, if this is kind of a true arbitrage type of strategy, why is one position so much larger in the options position? And that's where you're capturing the profit, as Mike said as well.
But I do think it's interesting, isn't it? Because I think if you contrast the illiquidity in the cash market versus the liquidity in the options market, maybe there's more you can do in the options market.
That's fine, but if we're saying they are basically buying 1x in cash and selling 7x, and their concern is where's the liquidity, then that seems to me more that they should be selling in both markets. Like, it's fine to express a bearish view, isn't it? You can say, I want to get short. I don't like Indian banks. I want to get short them. And the cheapest place to get short them is in the options market. So that's where I'm going to do most of my trading.
Yeah.
Right. And by the way, the short that they in aggregate that they put on was enormous, right? It's so I think the long in the cash market was like the equivalent of $400 million, I think.
Yeah.
So we're talking about $3 billion of shorts equivalent. I know we can all do the conversion to rupees, but it's if you're trying to put on such a big outright position, it's odd that you're doing the opposite thing in a related market, isn't it?
But do you think they were? But they're not. They weren't taking a view here, right? They were perhaps. You had lots of Indian.
How can you not be taking a view when you're net short $500 million?
Well, that's true. But their argument is that this was index arbitrage.
But it can't be index arbitrage
because it's 7.3 times. Fine.
Yeah. So it may contain. It may be that 1x versus 1x was like arbitrage, right? So they said, you know what? There's an arbitrage opportunity. Let's do single stocks versus index options. And then a separate person who's not on the arbitrage desk was saying, you know what, also, I've done all my technical analysis and all
the charts, I can see that.
All the pointing in the same way, and I'm just going to put on a big short. Where's the cheapest place to do it? In the options. And, there's a big Chinese wall between those two decisions, and it's all, very arm's length. So, that might be an avenue for the defense to explore in this example.
Yeah,
but if all of these trades and these options and these stocks are all being conducted by the same intelligence, it is slightly hard to understand, isn't it? By the same strategy. Yeah. So one of the other things I looked into, so actually for the days in question, as well as providing the 100 plus pages, SEBI also provide spreadsheets with minute by minute all of the activity that are going on both that option, but also the option expiring the next week, and every single strike point. And if you are conducting classic put call option parity arbitrage, in this case you would be buying the same number of puts as you were selling the number of calls. That's not what you see in that first patch. You definitely see them buying more puts, and things are not lining up perfectly at strikes. Now, that's not automatically saying that's, they might statistically have been constructing something which was highly correlated with the theoretically perfect, arbitrage. And they might have been forced to do that because there wasn't sufficient liquidity at various strikes for them to do the perfect thing. That might be one argument, but it's certainly not a classic risk-free arbitrage that they put on.
But did you? So I think it's very. We've been talking for about 25 minutes now, and we have been through like the case of prosecution. We've kind of convinced ourselves. We've been through the case of defense. We've kind of convinced ourselves. This is kind of it's very grey, isn't it? So there's a few things I'll probably call out. So. The allegation again from Jane Street, I believe, is that they were not given the opportunity to rebut this case or to give their side of the story. I think it just kind of landed one day out of the blue, despite they were given some warnings. I think SEBI uses the word warning. I think Jane Street uses the word like information letters to say like, oh, I think you should just make sure you check what you're doing in the Indian market or something like that. I think they received 2 letters, and then the third was this order. I think when you look at the facts of the case, if you're sitting in a surveillance seat or a compliance seat at a bank, I think your worst nightmare is this thing just landing on your desk one day. So there's a question here about if you were to look for something like this and you'd want to know that it was happening, what should you be looking for? That's quite hard because I think most, to argue that this was a index arbitrage strategy on the surface is possible, but you would never be able to rebut that unless you were able to say that on a delta hedged basis you were 7.3. It doesn't make sense. So you need to know from it that way.
Well, I think just to interrupt and riff on that a little bit. I think I think you have the added problem that if there's one market which is still principally surveilled from the perspective of a single security or single derivative contract, it would be the equities market. The principal historical approach still is in the dominant approach, I would say, in that market, and so you would have to start asking a question of how you would even have been alerted to this conduct. Yeah. Probably you would have seen something because you'd have said like, oh, it's odd, isn't it? They've been buying the single stocks aggressively as individual securities in the morning and selling them in the afternoon, and that in aggressive periods. So maybe this will trigger some kind of market dominance, or maybe it would trigger some kind of ramping alerts. But it would be one of many alerts, right? Which is the nature of that kind of quite straightforward rule being applied to many independent markets. And so identifying that this is one that is actually of concern, and this is one where profits were elicited potentially as a consequence of that kind of ramping behavior, I think it would be a challenge, right?
Yeah. I think it would put a lot of pressure on a surveillance analyst. Because as you said, you may get an alert and say, well, in terms of the, maybe the single stock futures or even in the equities markets, given the size of the trading activity, this aggressive trading activity, that triggers an alert. That's all you're going to see if you're only looking at that single product, that single market. So then that really puts all the onus on that surveillance analyst to then figure out, well, how do I even understand our position in the options market? How were we positioned there? How much money did we make on that? That's not all I can say from firsthand experience. That's not always information that's readily available for you. Sometimes teams are a bit siloed in terms of, well, your surveillance looking at equities and futures, and then there's a separate team over there looking at options or other markets entirely, and getting that information isn't always easy. So I think that's what kind of jumps out to me too at that point, in terms of trying to piece that all together retroactively is much more difficult when you have hundreds of alerts you need to get through, and other pieces to close out when you're not seeing the full picture too, or this you could see how it kind of slipped through.
But I guess it's true, but with this specific, so we've spoken about the challenges with what sounds like a sophisticated cross-product case, but the jury is, even in the industry, the jury's kind of out on this one still. It feels like, from the conversations I've had. I think, Mike, you've had some interesting.
Yeah. Actually, just this week, I had 2 conversations on the same day with 2 very smart people who are both very interested in this subject matter now, and who'd come to completely different conclusions. Yeah. So, one of them made a very strong case that, look, this is absolutely manipulative. Really picking up on the point that you're really benefiting from this asymmetry that first of all you get a convex payout from the option, and also you don't get any transactional exit costs from that position because of its expiry. And his opinion was that if this conduct had been discovered in the US, it would have been potentially curtains for the entire fund, right? Now, contrast that with someone else whose opinion I also deeply respect, who's a very smart person who had looked at it all and said pretty much nothing to see. I don't really understand what the fuss is about. It sounds political. So, and that was just in one day. Now, I think all of this is not helped by the fact, there's 100 pages to read to really get to grip. And when I first saw it, I actually leaped to a conclusion that the pattern would be more obviously abusive than it is, despite the fact that there's many questions that need to be answered. I think because I think when I first heard of the case, I assumed that if you were to set out to do this, the most effective way of doing it would be exactly, some of the fact pattern would be identical. You push up the cash market, and then I think ideally you would just buy a load of out of the money puts, and because they're out of the money, if you're you'll be able to trade great size without creating any requirement for your counterpart to sell large amounts of the underlying to hedge their delta if they're a market maker themselves.
Yep.
And then you will then go later in today, you'll sell your underlines. Your puts will start to become in the money. Your counterpart will have to be dynamically selling as well in order to push, in order to cover their delta.
And you just let it expire. You just sit there.
So on the end. So I was like, the first time when I just skim read the allegation, I was like, this is like the perfect Doctor Evil plan. Right? This is like,
how much to book a ticket to India?
Yeah. But it's made so much more complicated by the fact that it's not actually 100% cut and dry in that regard, because they're buying and selling puts and calls. Because what we're seeing is the aggregated trading activities, as I said at the beginning, of I suspect many decision-making agents. Because in the same data, you see them during the day buying an incredible amount of out of the money calls, which is clearly a very different strategy. They're buying them almost for nothing and then presumably closing them out at a loss later in the day. I'm not really sure. But that behaviour can have nothing to do with what the alleged purpose of their trading that day was.
So that's an interesting perspective, actually. And Andrew, you're an ex-regulator, so I'm keen for your view. This argument that within the same umbrella, the same, I get it, you have separate legal entities, but ultimately, if the parent, let's talk about parent company level, that you can somehow make the case that, there are different agents with perhaps opposite, independent decision-making capability within that umbrella, that you should view those things separately from a regulator standpoint, or is it like, it doesn't really matter, we're going to view you in the aggregate no matter what?
Yeah.
What's your view?
Yes, it's clearly, SEBI's clearly put the burden of proof on Jane Street to kind of say, well, if you look at FINRA broker check and your website, and they can point to a few different reference points to kind of say, you're all under the same umbrella. So I think there's 4 different entities trading here, and we're going to just kind of treat you in the aggregate. And clearly, they found legal precedent to do that and have issued this order. So it does feel like, granted, it is an order, and Jane Street can bring this to, I think they have like a securities tribunal authority that can look at this too. I'm sure that's one of the arguments that they would make if this is kind of aggregated out into different units. And then they would have to prove that they do have proper safeguards and walls and information barriers between each of those units, where they wouldn't have knowledge of how that trading activity was going between there. I think if you could prove that, I think there's
no mens rea. No, if these are all being independently, completely independent decisions, there is no mens rea. I think you will scienter. But I'm projecting into a legal jurisdiction I know even less about than I do about, the US. So, these are concepts which exist in the UK and the US, etc.
Yeah, and we don't know if, because
I think it is quite.
Go ahead.
But I think it is quite similar legal standards, and I think Shane, you and I were talking about this. They even kind of cite to some U.S. cases in different SEBI orders and things of that nature too. So I think it is. Granted, it's better not totally precise, but I don't think it's a wild conclusion to kind of look at in terms of how this would be looked at in kind of U.S. courts as well.
I think there's also, as we think about conclusions here and where we go, and I don't know if this is even possible or not. But I think there has been speculation that SEBI or even other international regulators may require that algorithms and algorithmic strategies like this are where the logic is presented and signed off by the regulator as legitimate. I can't see that happening. I can't see that happening, but
that just seems a very. I mean, that's like the difference between rugby and other sports, isn't it? So, like in rugby, before someone does something like jump over the top of someone else or try and like wrestle the ball or someone, sometimes there's like ambiguity.
You're sporting.
Whether the ball is in play or not, right? And they will ask the ref, like, am I allowed to go around the side of this person or something? And then the ref will go, yeah, you can do that. And it's but I cannot see this extent. Yeah. That just seems mad in financial markets. Because also, it's a massive break on innovation as well. No, I mean, if you're a fund, you would be lobbying crazily against this.
No, of course, and I think as I say, overheard in the halls of power. I've overheard it in much less powerful halls, but people are talking about this, and I can't see. I think a fund like an organisation like Jane Street or they will just exit the market if that was a requirement, right? So there's no way they're going to. Even if going back to Andrew's case about this employment issue that caused all of this to come to light, Jane Street didn't even want the market. They didn't even want to reference the fact that this was the Indian market. And I think the lawyer for the other side was like, as you know, this is the Indian market. Oh, sorry, Mr. Judge or Your Highness or Your Honor.
Strike it from the record.
Yeah, strike it from the record. But by that, the cat's out of the bag, right? So if they don't even want people to know what market that this is, I mean, there's no way. So I feel like that's a non-starter.
It would be a big shift because, I mean, currently, from my experience too, there are different, whether it be the Fed or various other regulatory agencies, they obviously have, if you are going to be implementing some sort of algorithmic trading strategy, you need to have properly tested that. And as well as like model validation has aspects of this as well. You need to be able, when they come in for an audit, prove that you have the right controls in place, like somebody in compliance would have looked at this to make sure it's not manipulative, it's signed off by head of markets, et cetera, et cetera. I mean, so it isn't like they're just kind of going in, well, at least they shouldn't be, just kind of going in and saying, here, I got a new strategy, go throw it into the market and let it run. There should be some governance already before that algorithm is then kind of trading in the market, and they should be able to prove that it's gone through those steps. So I would be surprised if they, and just in terms of like the burden that would put on the regulators to actually understand and approve all these, whereas I think they'd much rather keep that in-house and then say, well, actually we found that this algorithm is manipulative. You actually, here's your fine, plus your controls around testing it are wrong too. So here's your extra fine, and sort all this out in a big, remediation program with a monitor and, a bunch of consultants.
So we've come slightly through this without giving our own verdicts, which I think is appropriate, by the way. We're definitely
right to do that.
I'm not suggesting that we do that. But what information would help us get closer to the truth, right? Yeah. I think that's an interesting question. So for me, I would like to understand of these options, futures, and stocks, can they be segregated into different strategies, or different owners, different P&L owners, different decision-making agents? Because there is a lot of pollution in the data if there is multiple large, high-risk actors all conducting independent strategies.
I think like I mentioned before, in terms of the understanding the size of the trading, especially kind of the option position versus the cash and the futures position. The other aspect that I think would be crucial from a surveillance monitoring perspective is the timing, because they mentioned at least to me, was kind of hard to completely follow. They're saying there's a lot of this aggressive buying in the constituent stocks and the futures market, and that's pushing the index price up. But they're also saying subsequently they're going short in the options market. We know these markets are kind of informed in terms of pricing off of each other.
The market makers delta hedge, right? So are they just trading with people who are punters? But are people who are punters writing options? Is a retail investor going to be writing a put option for someone? That is the opposite of good leverage, right? You can lose
Everything.
a very large amount of money, or you can win a small amount of money. It feels like the opposite of a retail trade, if I'm honest.
Exactly. And then the same is true on the reverse, when they're kind of aggressively selling out all the cash in the futures positions. If they're not really concurrent, if they're not interleaved and it's kind of obviously aggressive buying, then you're loading up in the options, and then vice versa when ahead of the close. That's definitely one for me where I'd say this looks a lot more like manipulation versus, well, the relatively balanced timing wise, and there's just a lot more liquidity in the options market, and that's where they happen to be kind of they are a market making firm, so they are making more of a market in that space.
I've got to say, by the way, that if they are going along and like aggressively lifting offers in the morning in the single stocks and aggressively hitting bids in the afternoon, that's not market making. And market makers would expect if you had an independent market making algorithm on the single stocks, you'd expect it to be making small amounts of P&L most days, right?
Yeah.
Liquidity provisions is a service. They lost a substantial amount of money on this day if you just look at the single stock exposure, because they bought aggressively. You know what? You want to get something done quickly, you have to pay. They were prepared to pay. In the afternoon, they sold aggressively. You want to get something done quickly, you have to pay. They were prepared to pay. You add those two things together, they lost millions of dollars on the single stocks. But overall, across the whole day, they were up like $70 million one single day of trading in a very small segment of the universe, right? Like Indian banks.
Yep.
So if it's market making, it's a very complicated type of market making.
Do you think that holds because you're just looking at it on the cash side, no? But Jane Street is sophisticated enough where they would be looking perhaps.
Well, the single stock futures, they're doing exactly the same thing, by the way. Their index trading in Bank Nifty was not coincidental really with their trading in single stocks. They kind of built an index position after patch one, and then they sold it into the close as potentially extended market. Yeah. So your question might be, well, maybe they were just making markets in options and then laying the delta risk into the single stocks. And but then why have we got 7x delta?
Yeah, the big question is the 7x thing, I think. Yeah.
Yeah.
There was one other aspect of it too, and I'd welcome your guys' views as well, because I'm not sure which I would think would be more suspicious. But I think we've been focused a lot on the intraday, but it's focusing more on these extended marking the close aspect. I think conventional wisdom is that something like this for these indices in the futures and the cash, where the kind of closing calculation is this kind of volume weighted average price over the last 30 minutes of trading, that you focus on that last 30 minutes of trading. And I think to some extent, SEBI saying that they are more aggressive in the cash and the futures market in that 30-minute period when the index price is being calculated, but also noting activity in kind of the last hour as well. And it's kind of, to some extent, well, if granted that's the 30-minute, that's the window, but if the window, you're kind of already knocked it down a bit and you're starting at a lower point, then maybe it looks a little bit suspicious by conventional wisdom too. So that's what I'm not sure.
It's a great question, right? So you're basically saying, were you to have the objective of manipulating the settlement price, that daily settlement price, would you be better off trading exclusively in the period where the settlement price is calculated between 3 p.m. and 3:30 p.m., or would you be better off trading in that period, but also in advance of that period?
Yeah.
I think you're probably right. You could make a case that trading in advance, but kind of focused also at the beginning of that period, would kind of mathematically be optimal. I know we did some work on this. So, I mean, you can imagine, and we can create some fictitious numbers. If you wanted to sell a lot of something to push the price down in that fixed calculation, And let's say that I, did it in the window. At the beginning of the window, the price is unaffected because I haven't started trading yet. So it's a natural clearing level. And at the end, because I've traded aggressively, maybe it's 10 points lower. So on average, the index will close at a 5-point lower level because of my behavior, because we're going to take the average price during that 30-minute period. Now, if I had started trading 30 minutes beforehand, maybe my price impact is lower, right? Maybe it's over that 1 hour period, I don't push the price down by 10, I push it down by 8. So I end the window with an 8 depressed price, but I would enter the window with a 4 depressed price. And the average of 4 and 8 is 6. So, maybe in some markets, if you want to manipulate the close, you're better off manipulating over a longer period of time. And actually, if you follow this logic through, you'll find that the optimal thing to do is actually just to trade your full size in the first second of the window. That's like, were that possible, that would, because you would absolutely crash the market at the beginning of the window, and then people would be very frightened, and the price would not return, which would be quickly over 30 minutes. And but obviously that no one would do that even if they were so inclined, because it's kind of obvious what you've done.
So Andrew, why don't you now that you're back on the podcast, why don't you wrap us up?
Yeah, I think this has been a really interesting discussion on a case that is obviously very complex. I think this is to some extent the beginning of a lot of additional discussions that we're going to be having in this place. But, a few things that kind of strike to me too, and kind of putting myself in the mindset of, head of surveillance, head of compliance, when you're seeing this order, you're reading it, you're understanding it. What are you trying to understand around your own setup? Around how would I be able to identify something like this? What would I want to understand? Obviously, the cross-product nature of the trading activity that's going on here, making sure you have understanding of that overview. The fact that it is very much algorithmic trading, understanding what are the process in place do we have around our governance before we're implementing algorithmic trading strategies, how well are they tested, et cetera. And then in terms of the actual strategy itself, how my controls understand positioning specifically around this type of scenario where you have, relatively small futures and cash positions which are affecting a indice, which then you have massive option positioning based upon. How is that all kind of understood within the controls, the alerts? Very much understanding the timing of those tradings. So this is kind of the timing of the cash and the futures positions versus those options positions. What impact are they having? Market impact on the indice pricing as well, and then similarly around the closing time, understanding the market impact of those those trades in the cash that are going to impact the indice pricing ahead of the close, and not just within the closing window, but maybe around the close too. So I think there's a few different areas there where it is really kind of interesting, and where I'm sure we're going to be exploring further. So it's a bit of a shameless plug, but Trading Hub is going to be hosting our New York Reg Hub event in October. I can pretty much guarantee that these are definitely going to be themes that we're going to be exploring further, and also in terms of additional thought leadership and pieces that Trading Hub is going to be putting out around this kind of cross-product manipulation, alleged manipulation that's happening especially in the equities market. I mean, Shane, I think you and I were talking about, I don't think either of us have really seen this type of activity in this market before. It seems a bit novel to me, certainly.
So I think, yeah, absolutely. And maybe we just want to, as a test to see who's made it this far on the podcast, if you've heard Andrew's plug for Reg Hub in New York, come up to one of us, mention the plug, and you'll get a special piece of Trading Hub merch.
You're going to have to buy at least 3 pieces of Trading Hub against this, right?
All right.
Well, thanks very much for the time, guys. Yes, until next time, and not the last time, I think we'll be discussing this case. Thank you all.
Thank you.
Bye-bye.